The first one I'd like to talk about is a very interesting one that's not discussed enough, and that is, not only do not only do sort of charitable firms and society focused firms get sort of like substantial income, substantial income tax breaks, um, and corporate tax breaks. So not only this, right? But the really interesting thing is, but they are able to write off depreciation of assets at a higher rate than other firms. Although I should just be clear, non-charity, um, or instead of charity, you should really say charitable, right? Firms, because it is possible for a firm to be private and charitable, right? They just donate, a lot of money to charity or something, right? So that is a private firm that happens to be charitable. But yeah, you can offer accelerated depreciation. And that's very interesting. Accelerated depreciation is a very interesting concept. Just to sort of run you through it, you could have an asset. Suppose you have like a, actually, it's probably easier if I keep typing this. So, yeah, suppose you own computers. Yeah, computers. Um, Over time, we know that the computers will get old. They will get old and more, kind of harder, harder and slower to use over time. So, what we have to think about, okay, what we sort of have to think about at that point, um, is, in the balance sheet, when doing a tax return, the firm is able to write off to claim that some of the computer assets have lost value over time, right? The over time bit is key because he still owns the computers and can still use them, right? So there is some kind of like depreciation of assets over time that's happening there. And that's kind of like the key kind of thing to think about there. So it, think for example, most capital depreciation rates are, written to be approximately 33%, right? The typical UK sort of standard, right? Typically 33%. However, tax break, sort of tax break granted depreciations can be written off at up to 50%. Okay. Now that may not seem like a huge difference, but imagine running this over time, okay? Imagine the difference between the 33% and the 50% over time if these were some, seriously expensive assets, right? You suddenly realize that having a tax structure that offers, preferential kind of agreements to depreciation rates, having that sort of tax structure can be hugely in favor of producing a scenario where successful business people do indeed benefit others, right? That's the kind of yeah, that's the kind of key point to that one, right?